You've been trading long enough to know the truth most people refuse to accept. It's not the market that's beating you, it's your lack of a repeatable system. And today that ends because I'm going to give you something most traders never build in years, a simple, ruthless, disciplined trading playbook you can actually follow when money is on the line. A strategy without discipline is useless because the market does not reward what you know, it rewards what you actually do under pressure. Most traders think their problem is finding the perfect system. They jump from indicator to indicator, from strategy to strategy, believing that somewhere out there is a setup that will finally make them consistent. But the hard truth is that even a profitable strategy becomes completely ineffective if it is not followed with strict discipline every single time. The market doesn't care about your knowledge. It doesn't care how many videos you've watched or how well you understand candlestick patterns. It only reflects your execution, and execution collapses the moment discipline disappears. When a trader starts, they usually have clear rules. They define entry conditions, stop-loss levels, and profit targets. Everything looks structured on paper. But the real test begins when money is on the line and emotions enter the equation. In real-time trading, discipline is constantly attacked by fear and greed. A trader sees a setup forming but hesitates because of a previous loss, or they enter too early because they are afraid of missing out, or they exit too soon because they want to secure small profit instead of trusting the system. Each of these decisions may feel small in the moment, but together they destroy the edge of any strategy. Discipline is what keeps the trader aligned with their plan even when the outcome of the last trade was painful. Without discipline, every loss becomes personal and every win becomes emotional fuel for overconfidence. This emotional cycle pushes traders away from consistency and into chaos. A strategy is designed based on probabilities over many trades, not based on one outcome. But a trader without discipline stops thinking in probabilities and starts reacting to individual results. That is where the system breaks. Think of discipline as the bridge between theory and money. The strategy is the blueprint, but discipline is the construction work. Without construction, the blueprint is meaningless. You can have the most accurate trading model in the world, but if you don't follow it precisely, you are not trading a system anymore, you are gambling with ideas. And ideas change every second in the market. The biggest challenge is that discipline is not tested when you are winning. It is tested when you are losing, confused, or emotionally tired. That is when the mind starts negotiating with your rules. Just this one time, it says, this setup feels slightly different, it whispers. You can manage this trade manually, it suggests. And the moment you listen to that voice, you step outside your strategy and enter uncertainty. That is where losses multiply. Real traders understand that discipline is not about perfection, it is about repetition. It is about doing the same correct thing over and over again, even when it feels boring, uncomfortable, or emotionally difficult. Because consistency is built through repetition, not inspiration. You don't become profitable by doing something different every day. You become profitable by doing the same right thing long enough for probability to work in your favor. So the real edge is not discovering a secret setup. The real edge is becoming someone who can follow a simple system without deviation, especially when pressure increases. Because in trading, the difference between success and failure is not intelligence, it is the ability to obey your own rules when it matters most. Consistency beats prediction every time because the market is not a place where certainty exists, it is a place where probabilities play out over hundreds of outcomes. Most traders start their journey obsessed with being right. They want to predict the next move, catch the exact top, or buy the exact bottom. This desire to forecast creates an illusion of control. But the market doesn't reward prediction accuracy in isolated moments. It rewards repeatable behavior executed over time with discipline. When traders focus on prediction, they become emotionally attached to each trade. If the market goes in their favor, they feel smart and confident. If it moves against them, they feel wrong and frustrated. This emotional swing makes them abandon logic. They start changing their strategy after a few losses, even if the strategy itself is statistically sound. They stop thinking in terms of a long series of trades and start obsessing over the last one. This is where consistency breaks down. Consistency means applying the same approach regardless of recent outcomes. It means executing your setup the same way on trade number 1 and trade number 100. It removes emotional interference from decision making. A consistent trader understands that one trade does not define their edge. Instead, the edge is defined by the entire sample of trades. Some will win, some will lose, but the structure remains the same. Over time, this repetition produces results that cannot be achieved through random prediction-based trading. Prediction creates instability because the trader is constantly adjusting. One day they think the market will go up, so they buy aggressively. The next day they fear a reversal, so they hesitate. Then after a missed move, they chase price emotionally. This cycle creates inconsistency in execution, and inconsistency destroys any mathematical advantage a strategy might have. Even a simple system can become profitable if applied consistently, while a complex system becomes useless if applied randomly. Consistency also builds psychological stability. When a trader follows the same process every day, they reduce uncertainty in their own behavior. They are no longer reacting emotionally to every tick in the market. Instead, they are executing a plan. This removes decision fatigue and prevents impulsive actions. The trader is no longer asking, "What should I do now?" because the answer is already defined. This clarity is powerful because it keeps the mind focused on execution rather than emotional interpretation. Another key point is that consistency allows statistics to work in your favor. Every trading strategy has a probability distribution behind it. That means some trades will lose even if the system is good, but over time, if the trader executes the system consistently, the edge will show itself. The problem is that most traders never stay consistent long enough to let probability play out. They quit after a few losses or switch systems too early. As a result, they never reach the stage where the edge becomes visible. Prediction feels exciting because it gives the illusion of control over the future. Consistency feels boring because it requires repetition without emotional reward. But in trading, excitement is usually dangerous and boredom is often profitable. The traders who succeed are not the ones who get the most predictions right, they are the ones who execute their process the most times without deviation. In the end, the market does not care about your opinion. It does not reward your forecasts. It rewards discipline applied consistently over time. Prediction is an attempt to control uncertainty. Consistency is the acceptance of uncertainty with structure, and in trading, structure wins every time. Emotion is your biggest trading enemy because it quietly takes control of decisions that should only be governed by logic, structure, and probability. Most traders believe they are making rational choices in the market, but in reality, many of those choices are driven by fear, greed, frustration, or excitement. The market itself is neutral, but the trader's mind is not. And the moment emotion enters the decision-making process, the trading plan begins to collapse. Fear is usually the first emotion that breaks discipline. After a loss, fear of losing again becomes stronger than the confidence in the strategy. A trader sees a valid setup but hesitates because the last trade went wrong. This hesitation causes missed opportunities. Then, when they finally enter a trade, they exit too early just to secure profit, even if the original plan demanded holding longer. Fear creates inconsistency, and inconsistency destroys any edge that a strategy might have. Greed works in the opposite direction but causes equally damaging effects. When a trader is in profit, greed pushes them to expect more than what the system allows. A trade that should have been closed at a predefined target is left open in hope of a bigger move. Suddenly, a winning trade turns into a losing one because the trader refused to follow the exit rule. Greed makes traders forget that the market is not obligated to give more than what probability allows. It turns a structured plan into a guessing game. Frustration is another silent destroyer. After a series of losses, traders start feeling like they need to win it back. This emotional pressure leads to revenge trading, where decisions are no longer based on strategy but on the need to recover losses quickly. Position sizes become larger, entries become random, and risk management disappears. At this stage, the trader is no longer trading the market. They are trading their emotions. And the market always wins that battle. The most dangerous part about emotion in trading is that it feels justified in the moment. Fear feels like caution. Greed feels like opportunity. Frustration feels like determination. But none of these are based on statistical reasoning. They are reactions, not decisions. A professional trader must learn to recognize this difference. A reaction is impulsive and emotional. A decision is structured and predefined. To overcome emotion, traders need a system that removes choice during execution. When every action is already defined before the trade begins, emotion has less space to interfere. If entry conditions are met, you enter. If stop loss is hit, you exit. If target is reached, you close the trade. There is no debate in real time because everything has already been decided. This structure protects the trader from emotional interference. However, even with a system, emotion does not disappear, it only becomes manageable. The real skill is not eliminating emotion completely, but preventing it from controlling behavior. This requires self-awareness and repetition. The more a trader practices following rules under pressure, the less influence emotion has over time. Discipline slowly replaces reaction. It is also important to understand that emotional control is tested most during losing streaks. Anyone can follow a plan when they are winning. The real challenge comes when losses accumulate and confidence weakens. This is where most traders abandon their system and start improvising. But consistency only exists if the system is followed during both winning and losing phases. In trading, emotional control is not optional, it is essential. Without it, even the best strategy becomes useless. The market does not respond to feelings, it responds to execution. And execution under pressure can only be achieved when emotion is no longer the decision maker. Rules remove destruction, not opportunity, because most trading damage does not come from the market, it comes from the trader's own behavior when there is no structure in place to contain it. A trading rule set is not designed to limit what you can earn, it is designed to prevent you from destroying what you already have. The biggest misconception among traders is that rules are restrictive, when in reality they are protective. Without rules, every decision becomes negotiable, and once decisions become negotiable, discipline disappears. When a trader operates without strict rules, every moment in the market becomes an emotional conversation. Should I enter here? Maybe I should wait. This looks like a good trade, but I'm not sure. This constant internal debate creates hesitation, inconsistency, and impulsive action. One trade is taken based on excitement, another is avoided due to fear, and another is entered too early because of impatience. Over time, this randomness destroys any statistical edge that might have existed in the strategy. Rules eliminate this chaos by removing decision-making at the moment of pressure. If a setup meets predefined conditions, the trade is taken. If it does not meet the conditions, the trade is ignored. There is no emotional negotiation because the decision has already been made before the market even moves. This separation between planning and execution is critical. Planning happens in a calm state, execution happens under pressure. Without rules, execution becomes emotional and inconsistent. One of the most important functions of rules is risk control. Without strict risk rules, traders tend to increase position sizes after losses or reduce discipline after wins. This behavior leads to unstable equity curves where one emotional decision can erase weeks of progress. A proper rule set defines exactly how much risk is allowed per trade, how many trades can be taken in a session, and when to stop trading entirely. These boundaries are not restrictions, they are safeguards that protect capital from emotional misuse. Rules also prevent revenge trading, which is one of the most destructive behaviors in trading. After a loss, the natural human instinct is to recover quickly. Without rules, this instinct turns into overtrading, larger positions and random entries. But when rules are strict, they act as a barrier between emotion and action. A trader cannot simply double their size after a loss if their system does not allow it. This prevents emotional escalation and keeps the account stable. Another key benefit of rules is consistency. A strategy only becomes profitable when it is applied the same way over a large number of trades. Without rules, each trade becomes slightly different based on mood, confidence, or recent results. This variation destroys statistical reliability. With rules in place, every trade follows the same logic, which allows performance to be measured accurately over time. Consistency is what transforms a strategy from an idea into a working system. Rules also create psychological freedom. While it may seem contradictory, structure actually reduces stress. When a trader knows exactly what to do in every situation, there is no need to constantly analyze or second-guess decisions. This clarity reduces mental fatigue and allows focus to remain on execution rather than interpretation. The trader is no longer trying to figure out what the market means. They are simply following what the system dictates. The real value of rules becomes visible during emotional moments. In winning streaks, rules prevent overconfidence from increasing risk. In losing streaks, they prevent frustration from leading to reckless behavior. In uncertain conditions, they prevent hesitation from causing missed opportunities. In every case, rules act as a stabilizing force that keeps behavior aligned with long-term strategy instead of short-term emotion. Ultimately, rules do not stop you from trading opportunities. They stop you from destroying your own results. The market will always present chances, but without structure, those chances are misused. Rules ensure that when opportunity appears, you are still in a position to take it properly, not emotionally, not randomly, but consistently and professionally. Winning in trading is not about intelligence, it is about obedience to execution under pressure. Most traders assume that success belongs to those who understand the market the most, who can read charts better, or who can predict price direction with higher accuracy. But in reality, the market does not reward cleverness. It rewards behavior that is consistent, disciplined, and repeatable. The traders who survive and grow are not the ones who think the most. They are the ones who follow their process without deviation, especially when it becomes uncomfortable. Intelligence often becomes a trap in trading because it creates overthinking. A trader sees a setup but starts analyzing too deeply. What if this fails? What if there is a better entry? Should I wait for confirmation? This mental noise leads to hesitation, missed trades, or inconsistent execution. Even worse, intelligent traders often believe they can improve the system in real time, which leads to constant adjustments that break consistency. The irony is that the more a trader thinks, the less they execute correctly. Obedience, on the other hand, removes this internal conflict. When a trader commits to a predefined system, the decision-making process is simplified. There is no need to debate every trade because the rules already define what is valid and what is not. This removes emotional interference and reduces cognitive load. The trader is no longer trying to outsmart the market. They are simply following a structured approach that has already been tested over time. The real test of obedience comes during emotional pressure. Anyone can follow a system when everything is going well. But when losses appear, confidence drops and frustration builds, obedience becomes difficult. This is where most traders fail. They start questioning their rules, modifying their strategy, or skipping setups. They begin trading based on feelings instead of structure. And once obedience breaks, consistency disappears. Winning traders understand that discipline is not a personality trait. It is a trained behavior. It is developed through repetition, not inspiration. Every time a trader follows their rules, even when they feel uncomfortable, they strengthen their ability to execute in the future. Every time they break their rules, they weaken their consistency and increase emotional control over their decisions. Over time, this difference determines who survives and who exits the market. Obedience does not mean blindly following something without understanding. It means trusting a proven process enough to execute it fully before judging its outcome. Most traders do the opposite. They judge every trade individually instead of evaluating the system over a large number of trades. This creates emotional instability because each trade becomes a personal event rather than a statistical outcome. Obedience shifts focus from individual results to long-term performance. Another important aspect of obedience is acceptance of uncertainty. In trading, no setup is guaranteed. Even the best system will have losing trades. The obedient trader understands this and does not react emotionally to losses. They accept that losses are part of the process and continue executing the next setup without hesitation. This emotional stability is what allows the edge of a system to play out over time. Without obedience, even a profitable strategy becomes random. With obedience, even a simple strategy can become effective because it is applied consistently. The difference is not in the system itself, but in the behavior of the trader executing it. This is why two traders using the same strategy can have completely different results. In the end, trading success is not about discovering something new. It is about doing something simple repeatedly without breaking discipline. Intelligence may help you understand the market, but only obedience allows you to profit from it consistently. The trader who wins is not the one who knows more, but the one who executes better, especially when emotions try to take control.